Welcome back. What a morning, huh? What's everybody think? Yeah. I hope you all had time to make some new acquaintances and share your business ideas and network with some investors, make some new friends and connections, as well as enjoy your lunch. Next, I'd like to welcome the moderator of our next section, Al Culliton, who's the COO of Erie County's Industrial Development Agency. And I'll probably see you, Al, next week down in Cooperstown, right? And one of our seed stage sponsors. So let's welcome Al.
I'll be the one carrying the golf bag and putting all the balls in the 18th lake on the 18th hole. So, good afternoon. Welcome to a beautiful day in Buffalo. I think it's a wonderful occasion for us to celebrate a number of great assets this community has. You just had lunch at the Birchfield Penny, the Albright Knox, the beautiful weather. Buffalo's very fortunate today. It's my pleasure now to introduce Victor Thorne, the director of the Ohio TechAngel funds, and it's one of the largest angel group in the United States. Victor has a background which I envy. I was looking over his bio, spanning from Fortune 500 companies to entrepreneurial ventures. He is a co-founder of Broadline Capital, a global investment management firm, and in 2008, Broadline received the industry award for Asia Venture Deal of the Year, named by the Private Equity International group for Broadline's investment in China risk finance. Fortunately, I don't get a chance to invest in China, so that's probably just as well. In 2000, he co-founded and led business development for a leading provider of supply chain management and intelligence solutions to the trillion-dollar food industry, creating the industry's first SaaS electronic supply network. Victor began his career at Morgan Stanley, and he's consulted for a number of companies which I believe are contained in his bio. I think we have a lot to learn from Victor, and I welcome him to the podium. Look forward to an exciting presentation. Victor?
Thank you, Al.
You can take this underneath.
Okay.
Just leave it
Thanks.
underneath.
Great. I'd like to thank the hosts and sponsors and everyone involved. This has been a great, 24 hours or so far since I arrived. Buffalo's beautiful. I'm happy that the weather is as nice as it is, and been able to see the sights and see the art and get the energy flowing here, which is really awesome. So thank you for having me here. It's an honor to be in this role. It's a keynote, and hopefully after a nice lunch I don't put too many people to sleep, but it's okay if you slump in your chair. So I am the director of the Ohio TechAngel funds. I recognize some faces that are members of the Angel Capital Association that I see every few months at different events, but just a quick summary. We have 282 members that about half of whom show up once a month to our monthly member meetings. We began in 2004 with our first group and first fund that was raised. Since 2004, we've invested in 35 portfolio companies, and we've actually written about 56 checks, I think, with follow-on investments included in that. Our funds have invested a total of $8.5 million. And one thing that we have are funds, and then we have our members that can also invest as sidecars alongside our fund in promising ventures. So they are actually the majority of our investment are from individuals that invest as sidecar investors. The interesting thing is we feel like we're doing a decent job when we see venture capital or other funding sources join us as our companies progress. So one of our measures of success is to see if we're picking the right investments that others might be crazy enough to invest in as well. So our companies have raised an additional over $200 million in follow-on funding and co-investment from a lot of venture capital funds that people have probably heard of, like Sequoia, Claremont Creek, Charter Life, Draper, and some really good national and local venture funds. We've also been quite lucky to have 4 positive exits out of the 9 that have exited. The other 5 were losses, and so I'd say if we were playing baseball, we'd have a pretty good batting average. The good thing also with the 4 positive exits is our average internal rate of return actually met our hurdle with each of those investments, which was a 58% internal rate of return, which is 4 to 10 times return within 3 to 5 years. So there's a little bit of a background as to how we have been able to form an angel group that has 282 members. And a big piece of that is the government, the state government. Several years ago, the state taxpayers passed a $1.6 billion levy, or I'm not sure what the specific real term for it is, to go into innovation around the state. And so the state created these strategic goals that they sold to us, taxpayers and voters. And it was really a collaborative effort putting this together with the entrepreneurial community and investors and universities and companies that are global Fortune 50 companies. Everyone agreed that innovation drives businesses. Small businesses are the real driver of job growth, especially quality job growth. And as a state, we need to come together and pull together the resources in a smart way to stimulate this entrepreneurial activity. So you can see some of the keywords that they had in their strategic goals that they sold to us voters, and it resonated. 2/3 positive vote was an overwhelming success. But really, they're focused on job creation, wealth creation, really focusing on the industries that are pillar industries in the state. So typical life science, biotech, things that universities are good at. Battelle is in our region. So certain areas where we really already have strength is where we put our focus on. When the state got its money, they were very smart in another next action step, which was instead of them saying, now we have $1.6 billion and we're going to appoint one person to write checks and accept RFPs, they divided the state into regions and formed what they called entrepreneurial signature programs and incubators. So many of you have probably heard of Jumpstart and Ray Leach and the things that they're doing. I work with Tech Columbus, which is a counterpart to Jumpstart in Central Ohio. Jumpstart is Cleveland and Northeast Ohio. We have 7 regions. The good thing about that is different regions in the state have different areas of strength. They have different ecosystems. They have different sorts of research institutes. In Columbus, we have Ohio State, and we have Battelle, we have Ohio Health, and we have some large companies like Cardinal Health, American Electric Power. In Cleveland, they have a different system. They have Cleveland Clinic. They have many more Fortune 500 companies than Columbus does. They also have a lake. They have water. So there are a lot of different things that made it logical to split the state up into regions. Cincinnati's the same. They're on the river. They have different types of companies, different strengths, different universities, different hospitals. So what the state did was say, okay, let's be smart and create funding mechanisms that are managed by locals and put together a group of entrepreneurs, fund managers, and executives, chancellors at the universities, and pull them all together to run these separate groups. And let's ask them to go out and raise money from their community. So Tech Columbus is a 700-member organization. 700 corporate members actually invest and are members of Tech Columbus, and Jumpstart's very similar. The fund structures that they put together are the ones listed here. The newest is the accelerators, which are interesting. So I work with 2 accelerators, one that Tech Columbus leads called the 1492 Accelerator, and the other is the 10X Accelerator, which is managed by Ohio State. Both of those have been very successful, and there are accelerators all around the state of Ohio that are supported with $200,000 grants from the state of Ohio, which is, to me, very impressive that the state really understands that you don't even need a company to get money from the state. You need an idea, and that is good enough. For a large bureaucracy, I just find that fascinating that they've seen that vision and they understand it, and they're listening to the people that are on the ground saying we need things like this to foster this community and keep building the ecosystem. What Tech Columbus manages and the Ohio TechAngel funds are the pre-seed and the microfunds and the seed funds. We have investments from a Tech Acceleration $25,000 grant for sort of mobile apps and software companies that don't need a huge chunk of change to build their minimal viable product, to $50,000 Tech Genesis grants, which are focused on assessing intellectual property out of a university or researcher, looking at patent landscaping, market analysis, things like that. And a pre-seed fund that can invest up to $500,000 in a convertible note. And then the next step is the angel funds, which typically invest and lead $1 to $3 million Series A investments. One of the most important pieces is the tax credits at the bottom. Every one of our members, when our fund invests, gets a certificate in our fund's K1 that says, okay, you have an allocation of $5,000 or some number that you can basically send in with your state income tax it's basically a check from the state. Very lucrative, 25% tax credit off the state income taxes. We have I think it's around 6%, give or take, state income tax level. So it's a very attractive tool for us to bring in investors. So out of the gate, they have a 25% return of their capital effectively on investments that they make at this stage. Now, in particular, for the angel funds, Ohio's Third Frontier program has contributed $5.6 million to our funds. And the way that works is each of our funds has 99 members, and each of those members put in $25,000. So for accredited investors, it's not a huge bet, hopefully. We prefer not to have investors where a $25,000 check really creates a hole in their bank account. And you see the leverage, 5.6 million out of the nearly 13 million. That money is returned to the state if we are lucky enough to have enough exits. So our investors get their money back, then the state gets its money back, then everything else goes to our investors. So there's great leverage in that structure and great alignment with the state to get its grant money back but not participate in the upside. That's probably going to change because we've been too successful and the state wants to make money. Now it's a little bit different, but that's a good thing because they know that we actually are investing in good companies and there is a likelihood that there may be a positive return on the fund. If they didn't feel that way, they wouldn't care to restructure the next fund as traditional LPs or in a different structure. Another critical piece of the state funds is the Innovation Ohio Loan Fund, which is a low-interest loan that does not require personal guarantees, that a company can use the proceeds towards capital investments. So a lot of our companies needed to build things and capitalize expenses, and they get reimbursed 75% of their expenses in the form of this loan. And it's very low interest, very attractive, and in the 4 exits that we've had, every one of them had an Innovation Ohio Loan Fund, and that has significantly increased our internal rate of return and total return to our investors, as opposed to that being dilutive capital. So I mentioned Tech Columbus. Tech Columbus is the jumpstart of Central Ohio. We have 700 members in the community. We host about 200 events a year. We're headquartered in a old Simmons mattress factory. We have 30 companies that are in an incubator setting there. We have about 25 employees that range from investment managers to coaches to the entrepreneurs that come through the door. We work in multiple industries around biotech, life science, advanced materials, IT, IS, mobile apps. So it's really interesting when you see someone that's in nanotechnology that's coming out of the wet lab, bumping into the young, recent college grad that's hasn't bought a new pair of jeans in a long time, or at least the new pair is pre-torn or whatever. And those guys start talking, and it's just interesting to hear the synapses that are going back and forth from two very different angles. So Tech Columbus is really focused on connecting the community, coordinating the pillars in the community with the young entrepreneurs and everyone in between. We bring together the Cardinal Healths and the American Electric Powers and Nationwide Insurances to not just say, yes, we'll pay you $25,000 a year for our annual fee, but they actually come to our meetings. They meet with entrepreneurs. We have a first customer program that the 40 largest companies in our region have their chief information or chief technology officer sit down, I think once a quarter right now, and listen to pitches from companies that are relevant to their industries. So it's an accelerated business development process that we're really happy with. It's a very new program, but it has the engagement from the top. So we don't have a company selling medical devices that never got in the door to Ohio Health or Ohio State's medical system because they didn't have a relationship. It accelerates the process, gets early vetting of the technology, and it's highly effective, and it gets engagement in the community. So coordinating and collaborating allows for the real creation of strong innovation. We also have a Tech Start program that allows us to educate entrepreneurs early on and coach them on how to build a good pitch. The pitches earlier today were outstanding. We're talking about companies that are raising their seed capital to raising $35 million. And I was just very impressed by the diversity and the quality of the pitches. That's something that we spend a lot of time working with entrepreneurs to help them understand, no one in this room of investors understands the science to the level that you do. And you're going to scare them. If you focus on how easy and simple and how big this is and the value proposition, so basic things that get people excited, how to really put together a good pitch to get people excited and know the audience. And also, when you're setting up a company, if there are two founders, we educate the entrepreneurs. You might want to put together a buy-sell agreement or figure out what you're going to do when one of you decides you want out or get sick or something happens, because that usually kills a company when that happens. And so we think about a lot of the risks and worst practices and try to help people avoid those mistakes, and then we give them some pointers on how to really stimulate the people they need to get excited about their ventures. So as I said, the state divided us up into regions. We're in the center. We have no rivers, we have no lakes, a couple of ponds. It's very flat. There are a few hills as we go down towards West Virginia. So it's interesting because each of these regions has their nuance, and some of them are very tied to the auto industry, so they've been hit a little harder at different times. Our region is lucky that we didn't have a lot of resources. We didn't have a waterway, so we created a lot of different industry. So we're very diverse in our area. But the reason that it was split up this way is not only so that local regions can really focus on their strengths, but also so that there's a little bit of competition. And sometimes competition is good. It's hard to have a benchmark if you have one group statewide managing one fund, and there's no one to compete with to say, how are you doing, except choosing another state that may be a completely different ecosystem. So this gives us a chance to really see how we're doing in terms of job creation, returns, and making millionaires out of our entrepreneurs. So the TechStart program is focused on healthcare, biotech, energy, advanced materials, information technology, software. And one of the big pieces is to help commercialize research. So Ohio State is a big partner of ours, and we collaborate with them very closely. Battelle is another research organization, but we also have a network of hospitals and groups around that have really heavy research and ideas, but no real common thread to educate people when they have an idea how to actually commercialize it and get it funded properly. So the Tech Columbus is very effective in coaching and mentoring and creating opportunities. So this is a bit of an eyesore, but this is, I think this is a really interesting piece. So if you look at the bottom, the blue on the top are state or federal funds. The red are funds that are managed by the Angel Group or the Jumpstarts or Tech Columbuses. And then the green are market sources like venture capital or strategic investors or strategic acquirers and public markets. So we, along with the state, broke down the different funding mechanisms and their funding continuum. And we really think through, at different stages, what are the funding opportunities? And at the end of the day, we fill in the gaps, and that's where the state came in to think through where do we need to put funds, how do we need to break them up into what stage, and how do we stay organized and grade ourselves. So this is a very helpful tool for us when we talk with the people at the state and government entities that ask us what we're doing and where we fit in the continuum, and without us, how big of a gap would there be that would hinder the success of creating entrepreneurial successes. So we like to measure our impact, and at the end of the day, we have some proof that things are working. We've looked at nearly 2,000 companies over the last several years. We've invested over $20 million. The companies have raised almost $500 million that have been funded by any one of those earlier funds. They're generating significant revenues, and they've created 1,500 jobs, averaging around $66,000 a year. That's some pretty good tax revenue that the state's getting back as leverage. So let's get into the Ohio TechAngel funds, which is the most exciting piece of this, in my opinion. Our mission is to turn great ideas into prized companies to build entrepreneurial wealth. Our goal is not returns for our investors. Each investment our investors make through our fund, their stake is maybe $1,500 or something. So if they make 10 times return on one of the investments, it'll maybe pay for a month of their mortgage or something like that. Their real goal is to create entrepreneurial wealth and build entrepreneurial experience in the community, and with that, create more of a strength in the ecosystem. So one of the questions we always ask that we have to gain alignment with our entrepreneurs is, will they be happy with $3 to $5 million in their pocket in 3 to 5 years if they're successful? The reason some of you may say that's a lot, and many of you may say that's not very much. The reason that we use that number is we're very we're bookies. We look at evidence, we look at history, and we haven't seen more than one company every 10 years that's had an IPO in Ohio, so we're not going to expect a $1 billion exit with all of our good ideas. What we have seen are many companies Fortune 1000 companies acquiring our innovations for $20 to $50 million. And when we look back at how much money those companies needed to raise, usually they raised a certain amount that when they got their exit, they took home $3 to $10 million. So we want to get that alignment. We hope that a company sprouts and goes for $1 billion, but we want to make sure that when we have a company that is ready to be acquired for $30 to $50 million, that the CEO won't say, just give me one more quarter and we can get 20% more. And you start getting the price creep that creates dysfunction, and then the opportunity's lost, and we can't fund them. And the main reason is we don't have a lot of venture capital funds in Ohio, so we can't count on having a VC come in and save the day with a $5 or $10 or $20 million investment. So we get that alignment early on, and the 4 companies that we have sold were acquired by Yell PLC, a UK company. They've been acquired by McKesson, GSI, which was subsequently acquired by eBay. So big companies. I think my slide it's mad at me right now. So like I was saying, the 4 exits created 9 entrepreneurial wealth stories. 9 people that were founders or CEOs of those companies took home between $3 and $10 million after taxes and fees. So that's working. If we can do that with every company, we're doing what we think is great for the community, and we're returning a little bit of the capital to our investors. I think I'm frozen. So in summary, we've invested $19 million in 35 companies. Things are going really well with those investments. And there are a few things that we've learned along the way which have helped us create a better opportunity of success, because we don't know what we're doing. We really have just wung it from day one and try to learn from others and read every book we can find to figure out what a better way is in our process. And for those of you that know John Houston from the Angel Capital Association or the Angel Resource Institute, we're constantly trying to learn and create better ways of thinking. And since we really don't have a tremendous amount of experience in this investment community, we try to create standard processes as to how we're actually going to make investments and manage investments. So we don't just wing it. The early mistakes we've made, we invested in common stock. We ended up having no say on the board, and we got crammed down. And even though the company sold and made some good money, the venture capital funds that came in and took over the deal made much more of a multiple than we did, because we had no say in how things were going to be operated. Another company, we've just made a lot of errors that could have been deterred if we had sort of standard practices, and really in each company that we look at, think through what mistakes are we making. Here we go. We love the fact that we have venture capital in our deals, though. We have 18 venture capital funds that have contributed significant capital. One of our portfolio companies recently raised money from Sequoia and Claremont Creek, and without that funding, the company wouldn't have nearly the chance of a major exit as it does now. We also like to look at leverage when we think of how we tell our story to the government to keep them sending us grant money. And it's for every dollar that our members have put in our fund, it levers up to $10 in co-investment, which is, I think, fairly impressive. And we have a lot of things that we do to make sure that our members are engaged, because the Corral 282 cats is quite a challenge, but we're successful because we have a lot of educational programs and things that keep our members engaged and not bored. So what can we do to execute our mission and create more entrepreneurial wealth, create more jobs, and keep companies in the region when they do get acquired? That's the big question, and that's where, you know, we're confused. We constantly are trying to learn, and that's why we're very active with the Angel Resource Institute and groups to try to share best practices, and more importantly, learn what the mistakes others have made and mistakes we've made that we could correct. So we have a lot of documentation we put together. We have the 10 best exits list. I think around number 5 is actually get acquired and make money. Number 10 is just to wind the company down without a lawsuit, and how to do that properly. There are certain things that you know is going to happen, and if you don't prepare the right way, then you can really get yourself into a pickle. So we have some funny little things that normally you want to be optimistic, and we are, but we also want to protect ourselves from disastrous outcomes. So we tell our members all the time, until we make money, we're donors. Consider your investment into the fund a donation into the spirit of what we're trying to do. And if we return a check to you, have a party and enjoy it, and celebrate the new millionaires that were created in the room among our entrepreneurs who will circle back with us and be at the table with us as investors, and or start their next venture. Of the 9 millionaires we've made, only 1 has left the state. All of the others are in the ecosystem and part of our group. And I was bribed by someone to say ecosystem at least 100 times. So, some of the other great quotes, these are John Houstonisms. Our great idea is only as great as the problem it solves in the mind of the highest paying bidder. So, you know, we can be geniuses in our own boardroom and in our own research halls, but if no one's going to buy it, no one cares, it really doesn't matter how intelligent or life-changing it can be. And the last one, the management of return is impossible. The management of risk is illusory, but process is the one thing that we can exert an influence over. And that's something that we live by, is process and education. So we have, I think you might have seen earlier, we have directors on about 90% of the companies we've invested in that are members of our group. And in the panel yesterday, there was some interesting discussion about the value of a board. And that's something that we take very seriously. We absolutely do not want an industry expert from our group to join a board, because usually they want to go in and say, here are the problems with what you're doing, here's what I would do if I were in your shoes, and start picking on the operations of the company. That's not the board's role. That's an advisory committee's role or something like that, but not really the board's role to meddle with the actual operations. The board should really govern the company. And what's the most important thing about governance of a company? It's managing, hiring and firing and managing the CEO, and it's driving the company to a positive outcome. And so we require our board members to really think about educating the other board members, if needed, and the management team of what defines a positive outcome and what can that board director do to help drive that positive outcome. So we think about who are the venture capital funds that are relevant in the region that have cash. That's a problem. We have the VCs that are in Central Ohio or have no dry powder, so we can sit with them and get them excited all day, but it's not going to lead to anything because they have no capital. We really want to focus on the exit plan and think about how do we get to the exit? How does every board meeting get us closer to thinking about how we're going to sell the company? To whom, for what price, and why? And who do we need to talk to get there? And do we need venture capital funding? So we focus on the discipline of the capital plan and the exit. So here's some things that we need to have a view among our members that represent us on the boards. and as a group. How much do we invest per venture? This is something that we recommend every angel group, if you're going to raise a fund, to think about. Have a standard dollar amount that you're going to invest. There's a lot of risk in saying we're going to put $25,000 in this venture and $500,000 in this other and $1 million in this one and then $100,000. There's no consistency. Everything's one-off, and as a fund, it's very hard to stay on track when there is no track. It's just all over the place. And at that point, you see the larger personalities in a group coming out and driving every deal, and it becomes a bit dysfunctional. So we think about how much should we invest? What types of companies are we going to invest in? What kind of paper do we buy? Are we going to just take a term sheet and assess it one-off every time and buy notes here and common stock here? Or are we going to have some sort of grip on how we're going to do things? We think about what are the valuation ranges? How do we actually calculate that? Do we need to only invest in companies that we don't think will ever need a venture capital investment to survive? Because we have no venture capital funds in Central Ohio that have any dry powder, that's a problem. What's our rate of return hurdle? What's our goal? When we're thinking about the exit, are we thinking about creating financial buyers that buy on a multiple of EBITDA or cash flow? Or do we look for strategic investors that will put a premium on the synergies of the acquisition? And we prefer to lead, but we'll also follow cohort investors that have similar goals and are like-minded in the way that they invest in deals. And on each investment, what's our clear definition of success that we can track to and monitor? So in our point of view, here are some of the terms. Every group has its own. There is no right answer, but these are the things that we decided that are going to be important to us to invest the same every time. And we don't veer away from this path. We have a standard term sheet, and our cohorts in Cleveland, the North Coast Angel Funds, and in Cincinnati, the Queen City Angels, and 4 other regions around the state have also adopted a standard term sheet so that we can syndicate investments and raise $3 million for a company in a matter of months instead of competing on who has a more attractive term sheet and allowing and encouraging entrepreneurs to have dueling term sheets in the state. We prevent that by having Ohio treaty. We share due diligence with our cohorts around the state. We do our own deals. We don't do deals with them just because they're in or out, but we share information and we co-invest and we collaborate and we coordinate. Our hurdle rate's 58%, and we prefer to focus on investments where we can find evidence that there are strategic buyers that would actually bought companies in similar situations at certain stages for $30 to $50 million, and that's what we shoot for. We do not want companies that say they're going to have $10 million in profit in 3 years and they'll be bought at 2.5 times EBITDA. That for us, that's not attractive. And we prefer to lead, but as I said, we'll co-invest with other angel groups. We've only followed other angel groups in Ohio, and we only invest in Ohio companies because we have state funds behind us. So how do we define success? It depends on who we're talking to. Job creation's a big one, but we like lean startups. And there's the right time to grow jobs, and usually from our experience, it's right after the company's acquired and the acquiring company says you need to double in size, and we hoot and holler and say hooray, but we didn't have that drag while they were using our funds. We also have attracted companies from outside the state because we have an alignment with grant programs and non-dilutive funding sources that are very attractive for companies that are in states that don't have those programs. As well, our first customer program, for us to be able to hand someone a list of the companies in our community and say, if you move here within a month, you'll meet with the chief decision maker in each one of these companies that are relevant to what you're doing. That's an attractive proposition. And even venture capital funds have been a little bit enthusiastic about that program, where they may actually open up offices for portfolio companies away from where they are if it gets them close to a program that can get them strategic customers. And like I've said a few times, we really want to build entrepreneurs' wealth. You know, we have our angels, at least I hope most of our angels have enough money that if they make a couple $100,000 in gains off of their $25,000 investments, they're happy, but it's not a huge gain in their net worth. The real value is creating multimillionaires that are in the ecosystem and leading the charge for the next generation of entrepreneurs. So how do we get engagement from our members? How do we do all this? Well, we had volunteers. About 10% of our group volunteered to help create viewpoints and think through how do we create education programs for our members? How do we really get true engagement across the board? And how do we set processes and learn from our mistakes and document things so that we can continuously improve? So one of the things that we did was the Outcomes Committee. We had a pretty significant amount of time and resources committed by some of the members that helped put together some really good documents that became the Director's Toolkit. And our goal is to empower our directors to drive positive exits. It's pretty simple. So the 8 teams that we divided up in our group were clean books, records, and agreements. Boy, the worst thing that you want to hear if someone comes and says, we want to buy you for $50 million, they start due diligence and you don't have board minutes and your QuickBooks aren't updated, and they just start chipping away, and all of a sudden you go from 50 million to 30 to 20 to no deal. That's a really bad way to maintain respect in the community when you blow a deal because you didn't have clean books and records, which are a simple thing. But from day one, you just have to have that commitment to be professional and build a company to be acquired. Leveraging IP, fifth director. There's discussion yesterday about the fifth director being an industry whiz, and we prefer to have people that have executed properly exits, preferably in the industry that the company's playing in, and may have relationships with potential strategic customers. We have no interest in someone that knows the technology better than the chief technology officer and wants to run a clinic in every board meeting. That's a totally different, like I said before, advisory committee role. We put together a funding sources guide that identified all of the venture capital funds. We try to monitor who has dry powder, who invests in what industries and sectors and regions and all that, so that when it does come time to figure out the funding plan, we being the Ohio TechAngel Fund director, have a clue and can lead that charge and help select the venture capital fund. So we vet out, actually, we prefer not to have venture capital funds that have a history of moving companies closer to them and moving them out of a state or a region. So that eliminates a lot of the major venture funds on the West Coast. One reason that we invited Sequoia to invest in Ohio is because one of the partners of Sequoia is in Ohio now as the president and chief investment officer for Jobs Ohio. So he made them promise that they would not move AssureRx out of the state. So we created these 8 teams, and each one created documentation, and we presented all of them to our members over the course of weeks. So each monthly member meeting, we have a tutorial, we educate people on what we're doing, and best practices, worst practices, and it keeps them engaged, educated, and they get to understand what we're doing. Some of the things that we're really focused on, if you haven't noticed, are exits and getting positive returns. So for those of you that know the founder of OTAF, John Houston, he's read, I think, a book a day since he was about 11. And so he's read every book on investing, angel investing, and created 3-page summaries of each one. And we require that reading for our directors, but most are too busy to actually read them, so we give them the highlights. But here are 3 that we really think are good. Early exits from Basil Peters, ultimate exits from Tom McCaskill, and strategic entrepreneurism from John Fisher. What we like about each of these are they really help us stay focused. Basil Peters' early exits says the exit plan should be agreed to between the entrepreneur and the funding sources before the deal goes through. So if one group says we want $1 billion company or bust, and the other says we're happy with $50 million, we want to have agreement on what we can expect. Otherwise, when the company's doing really well, we have a board fight, whether you're going to raise $50 million in venture capital funding or sell the company. That's not a fun discussion to have for the first time when you're right there at that stage. You really want to have good open communication and agree from the beginning what the plan is. And plans always change, but at least you have something to start with. He also says, through evidence and research, that if there isn't a vibrant venture capital community in your region, then expect that you can get the $30 million exit, but it's hard to get an exit larger than that without venture capital participation. So what we'd love is to have 5 venture capital funds emerge with $100 million each of dry powder in our region, and we just tear that up and say, okay, the game's changing. Until then, we have to be realistic, set expectations that match what we actually have in the community and try to drive towards those as successes. Tom McCaskill talks a lot about really focusing on strategic assets and focusing on strategic, selling to a strategic buyer, and thinking from day one, who, what, when, and where do you need to look like and be and see and talk to really create the image of being beautiful to the right buyer. And at what stage, when you look at the targeted buyer, does the company need to look like to be optimal? So, you know, if you look at the comparable exits, and you look at Johnson & Johnson, for instance, and you say, okay, we wanted to see exactly how much money was raised and what companies had. Were they through phase 2 trials, or where were they? And that's what you shoot for. And I think if you really do a rigorous scrub of who the potential 3 or 4 targeted strategic bidders are, you can get a really good vision of what you need to look like and who your customers need to be able to get to that table with the right people at that acquiring company. So John Fisher is very similar. He says, pick this targeted buyer, steal or acquire their most impressive customer to them, and build your technology so it's totally aligned, and spend every day looking at that acquiring target and present yourself to them as the most beautiful thing they've ever seen that they have to buy. So our renewed focus is, you know, we want $20 to $50 million wins instead of home runs. We want to have, we want to avoid ventures that don't want strategic acquirers. And we love syndicating with our cohorts around the state. And we want 50 directors that can actually be helpful driving to the exit. And we always have a venture capital fund participate if it's a medical device or life science company, because we never have enough gas to get through a clinical trial with the FDA. So that's a requirement. Our exit roadmap, we really focus on these things, which are, you know, targeting the buyers, targeting the customers, targeting the right venture capital partners, and getting alignment with the entrepreneurs, and just having a good communication strategy with the team and the board and the company from day one. Here are things that in Ohio, in a little summary, that have helped us with the state programs, putting together the VC funds list. There are 25 venture funds and 7 angel groups. I think maybe 5 of the 25 venture funds have dry powder. We have a list of all of the investment bankers in the state. We have a relationship letter that we provide to all of our entrepreneurs before we fund that sets expectations of communication, reporting, and what our board directors' expectations will be and what the company should expect of us. We created these 7 things to give to our board directors so that they can be the smartest guy in the boardroom. Lessons learned. You can't expect every member that is a part of your group, if you have an angel group, to be totally engaged. A lot of them really just want to be supportive of the ecosystem, and we want to put millions of dollars in the founders' pockets, but we're happy if they don't get 20 or 30 million, because then they'll disappear. We want them to stay hungry but be wealthy enough that they can have a nice lifestyle. We want our directors to be strong, and like I said, the smartest in the boardroom. So when I talk about all the different things that we're doing in the community, if we were going to grade ourselves, I'd say we're C's across the board. We have a lot of room for growth, but we're really trying hard to figure out what we're doing, and I don't know if you noticed that everything there starts with a C, but we want to continuously improve. We don't take ourselves too seriously. We love to collaborate and learn from others, and our goal is to have a Groupon someday come into Ohio and create 1,000 multimillionaires, but until then we'll do it one company at a time, 2 or 3 entrepreneurs at a time. So thank you for your time. I hope I didn't go too far over. I think we have 10 minutes.
Sarah, where are you? All right, Sarah has a microphone. Victor, thank you very much.
Thank you.
Appreciate it. That was very, very good. I felt like I just went to a tutorial on how to do the job I've been doing for the last 10 years better. And I also, having taught school at one point, would mark you on a curve. I think your C is a little bit of a hard mark. So I have questions, but we have about 5 minutes, so in the interest of making sure everybody else's questions get heard first, does anybody among our entrepreneurs, our investors, have a question for Victor? If not, I'll start out with one very quickly. And you indicated that 10% of your members really are involved. One of the toughest jobs that I find is having an angel group or any group of investors have good directors on the board. And with only 10% of your people, or roughly 30 people, and you can drive the few good people really crazy. Mm-hmm. So how do you select directors? How do you make sure they will work at it? And the other thing is, how do you cover the risk of a director? I sit on a couple of boards, and they have this thing called D&O insurance, which I think means doesn't pay, and only when it's impossible to pay. So I'm not sure. Why don't you give me a little idea on that?
Well, last question first with the D&O. We've struggled with that, so we actually just decided to get a blanket policy for all of our directors and all of the portfolio companies that has full protection. So there's very little risk for them. In terms of engagement, we have about 100 members come to our monthly meetings. So there is engagement and interest. But when we dig into due diligence teams and board directorships, then it shrinks down to 30 or 40 members that get involved. So we're very aware of the risk of fatigue by abusing those that are most active. So it's interesting that I don't think we have any one of our members that's on more than 2 boards. So we try to make sure that we spread them out and give people an opportunity that have been in those committees and help design the programs. And when I talk about engagement, we have, of the 282 members, 100 have written a sidecar check, and 46 have written more than one sidecar check. But as you may have seen before, they've written a lot, and they're very active. The rest of the folks are just, they're interested, they love to learn. For them, $25,000 buys about 120 nights of meeting up with friends and learning new things and seeing new ventures and maybe being a part of something big. But the real celebration is creating that entrepreneurial wealth. And we've spent a lot of time cultivating and making sure that we don't become overbearing on the 30 or 40 that are active.
Yes. Sarah, don't mean to be rude, I just want to make sure everybody benefits from your question.
Thanks very much. Dick Frederick. I may have missed it, but could you talk for a moment about your operating funds? Where do they come from and how much do you have each year?
Yeah, the operating funds come from Tech Columbus, the grant from the state. So there are two sources of operating funds. One is a portion of the grant that's co-invested with the fund is put into escrow account for operating funds, and then the Tech Columbus and Jumpstart in Cleveland for the North Coast Angels and Cincy Tech and Cincinnati for the Queen City Angels have allocations to hire a full-time team, which is basically one full-time manager of the back office of the fund, and they do all the CFO and back office work as part of the grant program. So that is a huge piece of the puzzle, is having grant money cover salaries of people that are actually doing a lot of the work.
Hi, Dave Parrish. Thank you. Very nice talk. I like all the rules you have about how you comport yourself. Do you have one on valuations?
Yeah, we do have, I don't know if it's a rule, but we have a range. If a company is pre-revenue and it's not a life science or heavy intellectual property, we very rarely allow a valuation, pre-money valuation over $1.5 million. And we have sort of a sliding scale up to $3.5 million pre-money. And we pretty much focus on, most of our deals are in the $1.5 to $2 million pre-money. There's no science really, but sort of a range. And if a company has customers, that helps. If they have a product in the market, and it doesn't matter how much money they've raised before, we don't take that into account, grant funds or anything like that. It's purely where are they in the stage they are, and when we put them into the CEO payday calculator to see what it would take to get us a 58% return and that internal rate of return and get them $3 to $5 million minimum in their pocket, that validates what we determine is the pre-money that we'll invest in.
Victor, if the environment changed where you did have VC funding, actual powder sitting around in the area, if things go as you hope they will go, how is that the presence of the VC funding and the follow-on possibilities for A, B, and C rounds, how would you see that change the deal structure, the deal terms, and your approach to the whole thing? And then a quick follow-on question to that, if working with companies in New York region are a bridge to the East Coast VCs, would that be an incentive to Ohio to invest in companies in New York that can send technology and economic growth back to Ohio, but also bridge the VC trail into your ecosystem, I guess you could say?
If there were more venture capital funds in Ohio, I think very little would change except our $3 to $5 million and $30 to $50 million exit range. I think we'd structure the investments the same. We'd build companies with the target of being ready to be acquired at those levels, but we'd have a little bit more confidence that we could actually grow companies and position them for larger opportunities. So I think we just add a layer in there that says, okay, we're going to go for venture money. The reality is, we really do like companies that we think can be acquired within a couple of years for 20 to 50 million. It puts more money in the founders' pockets. When we look at the CEO payday calculator and we add $5 million of venture funding, in year 3, they have to create a tremendous amount of growth to get the same $3 to $5 million after dilution. And usually a venture fund is not going to sit and have an exit in a year or two. They want to get a 10x exit themselves. So that extends our runway from 3 to 5 years to 5 to 10 years. So there are a lot of complexities when we do look at when venture funds come in and what their expectations are. In terms of investing outside the state, it's difficult for us to do that with state funds. It's something we talk about. If companies are relevant and have resources that we could bring that are relevant to our community, it's something that we have discussed, and it's actually something that our state legislators are talking with surrounding states and states in the region about creating a shared tax credit. And I think that's very interesting, especially for the groups around us that are all bordering other states, and they're having a very difficult time because they're having cohorts from New York or Michigan or Indiana or another state invest in our vehicles, and we can't invest in theirs. So it's interesting. It's a good discussion topic.
Thank you very much. Appreciate it.
Thank you.
Thank you.